I'm sure you have seen these market scenarios in your trading. Especially nowadays, they are happening far too often. These are called as freak trades, and today we are going to see what is a freak trade and why you should know about it. Welcome to my channel. If you are new here, I am Dean and I use Dean Trading Framework to understand the markets and convert that understanding into trades in real-time market scenarios. If you want to learn more about how I do it, consider subscribing to my channel and ring the bell icon so that you get notified whenever I post a new video. If you are already subscribed, thank you very much. And you can help me further by sharing this video with your friends and colleagues on your favorite social media platform. Alright, so what is a freak trade and why you should know about it? A freak trade happens when market trades too far away from the recent development for a brief period of time and returns back swiftly to the previous area of development, leaving behind an island of trades which seem extremely unrelated to the recent market sentiment. Traders often wonder why it happens. Why do we get these freak highs and lows in Nifty and Bank Nifty? And there is just one plausible answer to this question, and that is lack of liquidity. Now, how exactly this lack of liquidity works out? We are going to look at an example of that very soon. Now that you understand the order matching process and how lack of liquidity causes these spikes, you might be asking why sometimes these spikes don't show up on my charts. And the reason is how the data is provided by the exchange. It is shared in 1 second snapshots. These 1 second snapshots includes the best bid price, the best offer price on that second, as well as the accumulated volume that was traded throughout that 1 second. So even though you get all the volumes that were traded during that second, you don't get all the prices that traded during that 1 second. And that creates a situation where your stop loss might be hit, but that price does not show up on your chart because it happened within that 1 second and not at the end of that second when the snapshot was taken by the exchange. So what happens inside that 1 second can be clearly seen in an order book. Let us take a look at what is an order book. And this is available in most of the broker terminals. You get the top 5 buyers and the sellers for any stock, option, whatever instrument you are trying to trade. So you can see there are these 5 levels, 5 prices, 101 to 105, where the sellers are available at these quantities. And here from 100 to 96 we have the buyers available at these quantities. Now there are buyers and sellers beyond these prices and levels, but in case of a level 2 data you will only get the top 5, but if you have a level 3 data you will get top 20. For all practical purposes, these top 5 buyers and sellers are sufficient for retail traders. So we'll just look at those. What do we have here? We want to find out how the order matching takes place. Let's say you have a short trade. You have sold 100 quantity and you put a stop loss at 101, alright, on those short 100 quantities. And you have put a stop loss market order. So your trigger price is 101, and as soon as that trigger price is hit, a market order is sent to the exchange and that order will be matched against the available quantity on the exchange. So what happens? As soon as the order goes, you can see that at 101, there are 65 shares to be sold. And out of this 100 quantity, 65 quantity will be matched at 101. But there are still 35 shares remaining. So we go one tick higher. We go to 102. And what you see here, there are 16 shares available. So of the remaining 35, 16 will be matched at 102. And finally, prices goes even one tick higher and the rest of the shares are matched at 103 and your order is complete. This is how order matching takes place. An order book is a real-time ledger of all the pending orders stored on the exchange. It is the responsibility of the exchange to match these orders to corresponding buyers and sellers. But that is where it gets very interesting, because how well the orders get matched, how well your order gets executed depends on a few things. Number 1, the liquidity or depth of the market. Number 2, the order type that you select, whether it's a stop loss limit or a stop loss market order. And lastly, what trigger price do you select to trigger those stop loss orders? Let us take a look at examples, one with good amount of liquidity and one with poor liquidity and how a freak trade sets up. So this is a stock, option, whatever instrument you are trying to trade. This is the order book for it, and you can see this is level 3 data. So that means we have top 20 buyers and sellers. All right. Same scenario. In this case, you have sold 150 shares and you have put a stop loss market order at 101. So as soon as 101 is triggered, your order will go to the exchange. And since it's a market order, exchange has to execute it till 150 shares are bought. Since your original trade is a sell trade, you will put a buy order in your stop loss, and so long as those 150 shares are not executed completely, exchange will keep climbing up this ladder and keep finding sellers to match these 150 shares. Interesting thing, the first 35 of these 150 shares are matched at 101. Then we go one tick higher, 102, and 14 more shares are matched. Then we go to 103 and 24 more shares are matched. But something very, very interesting happens here, and that is someone else has also sold 200 shares and their trigger price is 103. Your trigger price was 101. Now, by the time you reach 103, 73 of your shares of these 150 shares are covered, but there are still some shares remaining. Now, 200 quantity will be added to it on the exchange. So, your remaining shares plus these new 200 shares, now the exchange has to match all these shares before it can stop climbing up the ladder. What happens next is you go one tick higher at 104, 95 shares are matched, and now you have 168 shares that are in total matched, but there are still some remaining. Your order is now done because you had only 150, but these 200 quantity now needs to be matched. So the exchange will keep going up, and in this process it has managed to trigger another stop loss at 104 and 100 more quantities added. So if you consider from 101, we started with 150, but by the time we reach 104, now the exchange has the responsibility to match total of 450 shares, and till all those 450 shares are matched, it will keep climbing. So it goes to 105, 68 more shares are matched, 106, 107, 108, till it reaches 110, you manage to square off all the 450 shares. At different levels, different orders will be completed, they will get their confirmation, but exchange's responsibility is not finished because it has a total of 450 shares to be matched. Now, since this is a nice and liquid stock, you can see all the prices have corresponding sell orders and buy orders, and that is why the price rise, even though it looks like the instrument went up by 10 points, it's not much. And if the liquidity was even higher, let's say you instead of 35, 350 shares were here, then prices would not go up because your 150 will be matched and 200 still will be remaining at 101. So if the share is very, very liquid, the movement in the share is not very swift. Let us now take an example where the liquidity is very, very bad. And this is where you will find out how a freak trade sets up. And sometimes your stop losses are hit, but you don't see those prices on your charts. So let us look at here. Again, same thing. You have sold 150 shares. You put a stop loss market order at 101. At 101, there are 35 shares to be sold, and those are matched against your 150. Then to match more, exchange will start climbing the ladder. 102, 103, 104. No shares to be sold here, but 2 more stop losses are triggered. 105, 6, 7, 8 till we reach 109. Now we have 14 more shares. Those will be matched, but not enough. Again, the exchange keeps climbing up, and finally it finds another 15 at 119 and 25 at 120. And you can see still only 89 shares have been matched. We have now a total of 450. Out of those, only 89 are matched. And since all these are market orders, the exchange cannot stop matching the orders to whatever liquidity is available in its order book. Now, even though we just get top 5 or top 20 in case of level 3 data, it does not mean that the exchange order book is limited to those top 20 buyers and sellers. It can go well beyond that. So what is happening here? We again move higher, and now by the time we reach 151, now we have 100 more shares as liquidity and 189 will be matched, and then no liquidity till 177. So it moves even higher. Remaining of the 450, 189 were matched at 151. All the 450 shares will be matched at 177. Within milliseconds, the price has climbed for 101 to 177. The first snapshot that was taken, maybe it was taken at 35 when these 35 shares were sold at 101. All this process, it happens within the next second, in few milliseconds, and in few milliseconds price has rallied to 177. Exchange is not ready to take the second snapshot. Then what happens? Exchange will try to find where is the next buy order. Do we have to match it against these 2000 shares? But exchange does not find anything, so it starts coming down to find buy orders. And sometimes if this happens in a fraction of a second, there is no new liquidity that is added to this order book. The prices can collapse very, very quickly right back to where it was trading earlier in this 100-101 range. So within 1 second, what happened? Your stop loss got triggered. 2 more stop losses got triggered, and since there was no liquidity, price had to rally to 177 and come back down. Let's take the other side. Instead of putting a stop loss market order, if you put in a stop loss limit order, where when your price is triggered, you are not going to buy anything above 105. What will happen is, immediately a buy order of 150 shares at 105 will be put in the market. But if there is not enough liquidity available, like here only 35 shares will be executed, the remaining 115 shares will stay in the system at 105. So here you will see an order of 115 shares. And even though the rest of the orders will actually manage to take the prices up quickly, and maybe equally quickly they will fall down, your shares will only be bought at a maximum of 105. So when the market comes back down and you see some sellers coming down at 105, rest of your shares will be matched and your order will be complete. So that is the difference between a stop loss limit order and stop loss market order. If you have a stop loss market order, the exchange won't stop. But if you have a stop loss limit order, the exchange will stop at your execution price. In this case, it was 105. So even though your stop loss got triggered at 101, that was your trigger price, the execution price is 105, and not a single share will be bought at a price above 105. This is what will protect you from this weird liquidity crunch that sometimes comes in, and the exchange has to just keep moving higher to find the liquidity, and it will end up causing you heavy losses if you have sold some options or stocks and you don't assess the liquidity properly. The only way to protect yourself from these liquidity fiascos, these freak trades, is by putting in a stop loss limit order. So in this case, when the next snapshot was again taken after 1 second, prices actually managed to rally higher to 177, execute these 450 shares, then they did not find any liquidity and they came back down and started trading around 100 and 101, all within 1 second. So when the next snapshot was taken, what will come in that snapshot is the price will still be around 100, 101, but 450 shares will be traded. This stop loss will be gone, this stop loss will be gone, and your stop loss will be gone, and you will not see these higher prices on your charts because everything happened within 1 second, and the next snapshot that was taken was again at the same level. Although the volume that is provided is always accumulated volume, so all these trades will be showing up on your charts in the volume column, but the price may not show. And if the next 1 second snapshot was taken at this level, you will see some trading happening at 177 and then very little trading in between and prices again collapsing back. So you might get a very, very weird spike, which usually you can see on different charts, especially when there are freak opens and when market opens wildly away from the previous close, but then equally quickly comes back and starts trading around previous day's close. Why it happened? It happened because of this liquidity crunch. So after looking at these examples of high liquidity and low liquidity scenarios and how the orders are matched on an order book, the only thing left for you to do to avoid getting trapped in this low liquidity free trade kind of a fiasco is to always use a stop loss limit order. But now you may ask, what about the freak trades that happen at the open and how to deal with them? This happens again because of the lack of liquidity right at the open, and also because of the eager and impatient traders who put in market orders right at the market open. In case of limited liquidity, these market orders will cause the price to jump several price levels and reach where the liquidity is available. But once this initial rush is over, you will find that the markets return to normalcy and price starts trading at the previous area of accepted market development. Now you may ask, is there a way to exploit this particular situation to your advantage? Well, maybe if you have the level 2 and level 3 data. But again, it might be useful for someone who is trying to move big quantities or someone trying to do high frequency trading. But for retail traders like you and me, it is best not to get trapped into these low liquidity scenarios, these freak trades, and the best resort to avoid getting trapped is to use a stop loss limit order. So to summarize, I would say that it is always better to avoid such low liquidity scenarios. Always use a stop loss limit order so that you do not get trapped in these freak trades. And I suggest you always develop an attitude to inquire why these situations occur. And this is a very good time to talk about today's sponsor. Today's video is brought to you by Dean Trading Framework memberships. Yeah, these are my memberships. These memberships include courses that dive deep into the inner workings of the market. These courses will help you improve your market understanding and use that understanding to develop and execute trades in real-time markets. Check these memberships out at deantradingframework.com. So if you like this video, give it a thumbs up and don't forget to subscribe to the channel so that you don't miss out on such videos that I'll publish in the future. Don't forget, we publish videos every Friday at 10 a.m. Indian Standard Time. See you in the next one.